All right, okay, let's get started. So welcome everybody to another edition of the Microstructure Exchange. This is the last edition of our winter 2024 season. Although I think looking outside, at least from my perspective, finally summer is here. So that is at least good news. Before we start with the main feature, I just want to quickly alert you to the fact that we have another call for papers for the fall session. I put the link to this into the chat, but you will also receive it by email. The deadline for this is July 1st, Pacific time. There's at some point the system just cuts off. I think it's 3 a.m. New York time for those who care. And we're looking forward to seeing your papers. The fall season will start as usual sometime in mid to end September. And with that, now I would like to turn attention to our main feature for today, which is we're very happy to have Joel Hasbrouck here to talk to us about concentrated liquidity and automated market makers. Joel, I leave it to you. Just very briefly, you can put questions into the chat. I will accumulate them. And then Joel has, as he said, he has timed questions for about 11:15 and 11:30. At which point I will call upon you to ask a question in person, or I will ask it on your behalf. Yeah, we will just see how this goes from there. Joel, I'll leave it to you. The floor is yours.
Thank you, Andreas. I'm going to share my screen now. And oh, here we are. All right. Can everybody see that?
Looks
Good. Okay. Thank you. This paper is an economic model of decentralized exchanges with concentrated liquidity. And last week, we had at NYU 2 conferences on adjacent days. On Thursday, we had the Columbia Blockchain and Research Conference. And on Friday was the Stern Microstructure. So although these 2 areas are definitely related, I think the perspectives are different enough that I personally found the switch, well, my head was spinning. They're sort of different populations with different traditional ways, I would say, of looking at things. And this is one of those papers that is very much trying to bridge the 2 areas. So although its roots are definitely in the crypto market literature, I wanted to present it in a way that tries to connect to a microstructure audience. And for that reason, you'll see that I'm going to deviate quite a bit from the order of presentation in the paper itself. Now, there we go. The broad topic here, decentralized exchanges. We already have a number of very good papers here, and Lahore and Parlor, and Zoikin have done a lot with the setting of fees and the industrial organization. Caponi and Gia also on DEXs. Our session chair and Katya have long been there. I think Andreas started working in this area before just about anyone else in microstructure. And but other contributions have come from the operations research or computer science areas. And that's because that's the technology that these exchanges, of course, draw very much on. Now, this specific paper is modeled very precisely on Uniswap v3. So it is one variety of crypto exchange. And in the course of this talk, I'm going to try and distinguish it from its predecessors, and if I have time, from its successors. The main result in the paper, and here I'm definitely deviating from the order of things, to skip to the chase, is that liquidity provision in a V3 market approximates an investment of a covered call, which is a portfolio where you write or sell a call and you buy the underlying. All right. Now, in traditional market microstructure, we are used to, or at least we've encountered, the idea of liquidity as an option. The classic paper here is Copeland and Galai, Information Effects and the Bid-Ask Spread, JF 1983. And the intuition here that comes through very strongly in this paper is that the liquidity provider, the dealer or the market maker, is short both a call option to buy, that's the ask, and a put option to sell at the bid. And the combination of a call and a put with different exercise prices, nowadays we would call that a strangle. So if I want to set up sort of a thinking point here leading into this paper, I point out that being short a strangle in the Copeland-Galai world is very different from being short a covered call, which is what we have in this paper. And I don't want to make too much of this contradiction. It's not a puzzle, it's not an inconsistency, but it is a difference, and I think it needs to be reconciled, and not just for technical reasons. I hope to convince you that the reconciliation of these two perspectives can really help us understand what supplying liquidity is in these two different worlds. So first, since at least all the microstructure people in the audience here are going to remember this, but it may be new to the some of the crypto native people. Copeland and Galai viewed what the market maker did in 1983 as this. When the market maker puts out a bid, they are giving to the market a put option with an exercise price at the bid. So the market maker is agreeing that she will buy at the exercise price. And also at the ask price, the market maker extends a call option. And this is a combination of this is a straddle, or a strangle rather, because the exercise prices are different. So what do the payoffs and profits look like here? Well, if I am long a strangle, I have that picture at the far left, that's the payoff. The market maker is short a strangle, so they have the picture in the middle, that's their payoff, but they have to make a profit. So if we were dealing purely with auctions, the profit would come from the premia involved in, I'm sorry, the profit would come from the premia involved in when the put and the call were sold. All right, here, what's going on, Copeland and Galai, it's actually a very advanced paper in many respects, but they are working in the kind of classic, I'd say the Gloston-Milgram world, except they preceded Gloston and Milgram. And they said that informed traders will exercise if the informed value is below the bid, or they will lift the ask if the informed value goes above the ask. And then when the incoming trader is uninformed, there's no change in the value. And that's the equivalent of receiving the premium. And Copeland-Galai, it's an equilibrium model, and they balance those things. Right. Now, the market that I'm going to be talking about here, it's an open source protocol, really, that is developed by uniswap.org. And these protocols are kind of a way, or they give us a way of interacting with the Ethereum blockchain. Now, uniswap.org is an open source software project. It is distinct from Uniswap Labs. All right, Uniswap Labs develops software and does other things as well. And the distinction is important because the SEC a couple of weeks ago targeted the labs with a Wells notice indicating possibly imminent legal actions. And one set of these protocols is the one that we're going to be discussing today. It's a one that does automatic market makers. And I should point out the Uniswap Labs, we can't see the Wells notice because it's delivered privately to Uniswap Labs, but the some law firms, or Uniswap Labs law firms, have put out kind of a response for that that is circulating. So stay tuned to that one. That's sort of a separate story. Now, what are these automated market makers? Well, first, I should point out that they are not entirely new to microstructure. The first use of the term that I've found in the finance literature dates from a paper by Nils Haakonssen and Avram Beja, who both of whom have written other papers in microstructure. JF 1985, the feasibility of an automated market maker. And the idea here, and other people had the idea around the same time, it was discussed, could the specialist be replaced by a computer? And in this paper, we're going to be looking at a very particular AMM. So one kind of Uniswap protocol, and anyone can invest in the AMM. When you do this, you contribute capital to a liquidity pool. And when we do this, we become partial owners of the pool. And like any market maker, we stand ready to trade and accommodate the trading needs of others, the incoming customers. So a customer can propose a trade against our pool, our AMM, and the trade formally occurs when this customer's, call it a proposal, is settled and it's on the blockchain. And then it becomes irrevocable and immutable and so forth. But the timing is an issue that I will return to. Now, to put this in classic microstructure terms, the AMM, the liquidity pool, we're the passive ones, and the customer is active. And of course, nowadays, they're being a market maker is not a monopolistic thing anymore. And both in traditional markets and in these newer markets, there can be multiple AMMs. And very often it's going to be useful for considering or viewing the AMM like a distinct exchange. For a microstructure audience, that's sort of where I would start. And then once things get added to the exchange or get added onto the blockchain, everything is on the blockchain. And you have a complete state and history of the AMM, all of its capital contributions, all of its withdrawals, and all of its trades. And because the Ethereum blockchain is decentralized, we call these things decentralized exchanges. Now, the first one I'm going to look at is actually a precursor of the one that this paper is about. It is Uniswap V2. And when we set up the pool, we're going to define two tokens that are going to be exchanged. One of them is the US dollar. Now, of course, since this is a blockchain, it is a token that can be, it's called a fiat token and can be exchanged in principle for $1. And the other is going to be Ethereum. The pool is going to hold inventories of each, and the ratio in the pool is going to be the current price of the Ethereum in terms of the dollar with respect to this pool. And if there are other exchanges, we would expect that this price is going to be pretty close to the prices on the other exchanges, subject to arbitrage. Now, how do trades occur? Well, behind this V2 pool is something called an invariant. So in the V2 pool, the terms of trade are going to be set so that the holdings of Ethereum and the holdings of USDC, the product of those two things is constant. And as a customer, say, purchases Ethereum, the Ethereum holdings are going to drop. The US dollar, USDC holdings are going to increase. And the terms of the trade are such that the product after the exchange is the same as the product before. And that defines the terms of trade. So, as an example, let's look at a pool that has $200,000 and 100 Ethereum. So the implied price of the Ethereum, excuse me, is $2,000. Then right here, with 200 Ethereum in the pool and $200,000, this curve indicates sort of the line of possibilities. It's called the bonding curve, starting from this $200,000, 200 Ethereum starting point. And when we trade in this pool, we are sliding up and down along this curve. Now, there's another way of translating this situation, which is in terms of the incoming order. So now I'm putting that on the horizontal, the marginal price on the vertical, and at 0 incoming order, we're right at the starting point. A purchase takes us to the right along that curve. The marginal price goes up. A sale from the customer is negative incoming order, and that drives the price down. Now, what happens if the pool gets bigger? What happens if more people decide to supply liquidity? Well, to invest in this pool, investors can deposit additional USDC and Ethereum in the ratio of the current pool price. So that's 2,000. So suppose that the pool doubles in size. That takes us from $200,000 to $400,000, and from 100 to 200 Ethereum. It takes us from the blue line to the red line. And the red line with the larger liquidity pool has, not surprisingly, better liquidity. So the blue line that I just showed you is the marginal price for the original liquidity pool, and the red line is the same line that corresponds to the larger liquidity pool. It's flatter. There's better liquidity. We can trade larger quantities with a smaller price dislocation, which is, the way we normally view liquidity in traditional and crypto microstructure. Right. So this is V2 liquidity, and it's great, but there's a problem with it. It has a very high capital requirement. So here we were comparing two different sized liquidity pools. The larger one, corresponding to the red lines, had 200 Ethereum, $400,000 US dollars, for a total value of 800,000. And just think, for a frame of reference, think of a stock with a price about $10. Limit order book has, say, 1,000 shares on each side. So this is not SPY or Amazon, but this might be a medium liquidity stock. And if there are 1,000 shares on each side at this price, well, the capital commitment in the behind the book is much smaller. It's about $20,000. And that capital commitment might cover a price range of, say, plus or minus 5% away from $10. The limit order book, it provides less liquidity. It's concentrated in a narrow price range, but its capital commitment is much smaller. And the high capital requirement of V2 emerged very early on in its usage. So the next version was designed also to allow for concentrated liquidity. I'll pause here to see if there are any questions about the V2.
So I see nothing in the chat. If anybody has a question, you may just as well raise your hand now. Or
Okay.
forever hold your peace. No questions. Okay, just carry on then.
All right. So how are we going to do this transformation, move from V2 to V3? One is we impose price bands. A pool is not going to offer liquidity over the full price space. Instead, it's going to be limited to relatively narrow minima and maxima. And also, we're going to transform that constant product rule. We're going to modify it to a certain end that I will explain in a minute. So first, let me show you the price bands. Now, what I've done here is impose price bands on that blue curve from the V2 AMM. And what these price bands do, and first notice that they are geometrically or logarithmically spaced. So at lower prices, we have more price refinement. And as we get to higher prices, the price bands expand. So within each price band, we have a distinct AMM. And here they're kind of color-coded, so you can see where they're located. Each one lies fully within a price band. So that's the first attempt to sort of restrict or concentrate the liquidity. The second thing is we transform the constant product rule. Now, if you go back to the V2 rule, over the entire range, the pool is always composed of both of its entities. It has both Ethereum and US dollars. The V3 liquidity pool does not. At its endpoints, it's going to be one or the other. So for this purple, call it the purple pool, at the lower end of its price band, it's 100% in Ethereum, and at the upper end, it is 100% in US dollars. And then, so what you see here is we really have like a family of AMMs, and each one operates independently. Each one is follows a slightly different rule, but they all have this property that at the lower end, they are 100% in Ethereum, and at the upper end, they're 100% in the dollar, which is the numeraire. Now, how do these different AMMs sort of interact with each other? Well, first, if they all have some capital in them, the total pricing curve or the union of the pricing curves is going to be continuous, but it won't be smooth. That is, at the breakpoints, at the price limits, there is going to be a discontinuity in the derivative, right? There's also another possibility, which is as we can see that as the price changes over a wide range, we're going to be moving from one pool to the other. What happens if we encounter a pool somewhere in the middle, say the red pool, that doesn't have anything in it? In that case, we're going to have a gap. And so what would happen is if the red pool, for example, has no, if that liquidity pool is empty, if we wanted to trade more than, say, 11 Ethereum, we would jump up to the purple pool and we'd see a price gap. Now, where does this covered call intuition come from? Well, think about what happens if we are first at a price of, say, well, something in the middle of the red pool. All right. And as the price goes up, the red pool runs out of Ethereum to sell, and we move into the purple pool. At this point, right at the beginning, that purple pool has 100% Ethereum in it. And as additional buyers come in, we're going to move up in this direction. Eventually, at the upper end of the pool, where we will have bought, more, or I'm sorry, we will have sold more Ethereum at increasing prices. And there's a sense in which that at the upper limit, the call has been fully exercised. That is, people have purchased Ethereum from the pool. If the price goes any higher, we're above the limit, and we have no obligation in the purple pool to provide liquidity at that higher price. So the trading would move on then to the orange pool. Now, what happens if we go in the other direction? Well, if we move in the other direction, the price is dropping, and our purple pool is buying Ethereum at progressively lower prices. But then at the bottom of the pool, at that lower limit, we are 100% in Ethereum. And if Ethereum's value drops any further, the value of our liquidity pool is going to drop as well. So we are bearing the downside risk. So back to the comparison with Copeland and Galai. Remember the strangle view of liquidity supply. In their model, that strangle is not hedged, which means if there's a large price movement that takes the valuation way above the ask, the market maker, the call is going to be exercised against the market maker. That means the market maker receives the ask price, but then they have to go out in the market, buy the underlying at V, and sell it to the person who lifted the ask. And then on the downside, the market maker is going to be exposed to the full downside. Now, in V3, though, the price movement upward through the purple band is associated with this portfolio shift. So the AMM keeps buying the underlying, but they don't go above the upper limit. So unlike the Copeland and Galai case, we don't worry about the valuation completely blowing through the ask price. So the way I reconcile these two views is that this shift, this portfolio shift that occurs in the AMM, it doesn't completely hedge that adverse price movement, but it does cap the cost. Right. So let me pause right there. Are there any questions at that point? Because
so there were a few questions in the chat.
Yeah.
So one of the questions came from Jackie Tan. He essentially asks whether or not, well, she asked why. I'm going to reformulate whether or not these price bands that the algorithm imposes are in some form optimal, being geometrically spaced.
Are they optimal? Well, as my co-author Fahad says, tell me what you're trying to maximize, and I'll tell you if they're optimal. Now, I'll come back to this question, but a short answer is no. They are not generally optimal. They are designed, I would say, with respect to the geometric bands, I would say that the spacing is designed to be more flexible than a fixed tick size, like say an eighth of a dollar. All right, so there's a pretty good intuition that they should be superior there, but optimal in some broader sense, no. That I believe is a difficult problem. I'll come back to it.
And so just as a general observation, I mean, one of the features that you bring out with your result, describing this as a covered call is in fact that a market maker here has to be an owner of the underlying already, right? In contrast to market makers in traditional finance. So that also somehow indicates that possibly the people who become market makers in an AMM could also be different entities, right? So there may be investors that it's almost like in some sense, when you put in a liquidity position, which is say high above the current price, that's feels like the inverse of a stop loss order in some form, right? I'm not sure if there's a name for that. because you sell when the
Um,
price moves sufficiently.
let me think about that one. Um, the price, um, is it triggered by a trade? So a stop loss order, I think of that as being triggered by a price movement, and that price movement can occur in any market. All right. Here, the MMM, the AMM only follows the rules of its own price dynamics. So, for example, if there were a price in some different market that were far away from the AMM's current price, it wouldn't necessarily trigger anything. It might trigger an arbitrage trade, but it's not automatic.
Oh, so and if I may make one comment, this is not about your paper so much but about AMMs generally. I think actually one really cool feature of AMMs is if you think of a limit order book, in a limit order book, if the price say moves up, as a market maker, you would have to repose both at the bid and at the ask if you want to sort of maintain a tight band, if you want, in terms of the prices, right? Whereas in an AMM, you don't. If the price moves up and then subsequently moves down right away, you're basically trading in both directions, right? So there's
Thank you.
no.
Yes, you're right. Andreas is calling attention to the two-sided nature of liquidity provision, and it's most appropriate, as you say, for an agent who's acting as a market maker, always posting two-sided liquidity. It is, and I'll return to this, less appropriate for somebody who is using a limit order in a one-sided criterion, in a one-sided objective.
Yeah.
But yes, they are
So
called automatic market makers, not automatic limit orders.
let me quickly ask Mark. Mark raised his hands. Why don't you unmute yourself and ask a question?
Yeah, quick question, Joel. I'm just trying to think practically if we thinking of this, if a large order comes, it sweeps through one band and then jumps to the next band and sweeps through that band and jumps to another band.
In principle, yes, that's exactly right.
And then lastly, Peter put something in the chat. Maybe you want to ask that question or make that observation in person. Or no.
Okay.
Okay. All right.
All
Okay.
right.
So then Peter
So
doesn't want to
let
speak up.
me
So fine. Then let's just carry on.
move on. Um, so now that we've, I think, characterized this liquidity, its payoff function, and its construction, and how this portfolio effectively is managed. One of the nice things about it, because it is in an equilibrium, and at this point we're moving to an equilibrium framework, we can value this pool under the risk neutral probability measure, which means given a stochastic process for the value of the underlying, these valuation dynamics, we can compute in equilibrium what the size of a particular AMM should be and characterize the dynamics of this pool. So using this risk neutral valuation, we can develop this option intuition into, we hope, some useful empirical predictions. Now, the question came up, optimal grid sizes, or equivalently, the optimal fees. What can we say about these? Well, in this world, so far we are taking the stochastic process for the underlying as exogenous. Start changing the grid sizes, start changing the fee level, and market participants, liquidity demanders, may change their behavior. And it's that feedback there to the broader market participants that will change the general equilibrium in this market. And we have much less to say about that. I believe it's going to be a complicated problem. Now, I'd like to make some other points about this, which is that in a limit order market, you execute the limit order, it's gone. If you have a bid, buy limit 10, and the price, or if the bid gets hit and the price goes back up again, I don't have to sell. The AMM, as was mentioned, supplies liquidity on both sides. I also haven't said very much about fees. Turns out when you execute against an AMM, the customer pays what we might call an access fee. And it's a proportional fee, like most of our TradFi access fees are. Here they are very necessary in equilibrium. And other authors have noted this, and the AMMs can be differentiated both by, well, grid or tick size, but also by these fees. And Lahar, Parlour, and Zoican note that the larger pools tend to be the low fee pools. And then I haven't spoken to this point much about how the, and I should probably wind up formal talk. I haven't pointed out yet how prices are determined. So when the AMM is set up, people contribute capital, US dollars and ETH, in the ratio of the current price. Where does that come from? In most of these models, we invoke a separate market, a centralized exchange, and that is where the price discovery occurs. The AMM is mostly viewed as the provider of liquidity rather than a venue for price discovery. As such, it's exposed to arbitrage. The AMM prices are always stale. So if there is a movement, if there's price discovery in the centralized exchange, it's the AMM that will be hit, and the AMM gets traded against at its own prices, which are stale. This has been called loss versus rebalancing, or lever, and it's an arbitrage thing. Now,
can I ask a question about that, actually?
Yeah.
So because I think there could be an interpretational difference too. So there's a question between permanent and temporary price movements. So Christine's paper with Alfred in the JF, they actually have explicitly modeled arbitrage trades occurring also in both directions. So let's put it differently. Every trade in an AMM moves prices.
Yes.
And then it's possible that therefore a trade that is, say, not information-based would move the price and requires a trade in the opposite direction to move the price back to the correct level. Now, that is also an arbitrage trade, which, however, benefits the market makers because they
That's
receive
correct.
fees on those. So I think, all I wanted to say here is this is where possibly this two-sided nature of liquidity provision, this automated two-sided liquidity provision, actually is a case where arbitrage, in some sense, the mechanisms of arbitrage create extra fee income.
Yes, as long as the information is not, as long as the price movement is not informational, the arbitrage in the other direction, which is really a restorative force, is actually is profitable. Yes, which is a point I think you've made. The market maker makes money from balanced order flow and loses to one-sided order flow. Often in these models, the liquidity traders, if there are one-sided liquidity traders, there are traders, opportunistic traders on the other side that restore the price, and that balanced, essentially give it balanced in order flow, which is profitable. That's a good point.
This is like essentially reversals. As long as there's reversals, we're
Yes.
profiting.
Yes. And so where do we go from here? We are on Uniswap v3 protocol. V4 is supposed to be introduced any day now. Its release is imminent, and when it is released, it will have additional degrees of flexibility that allow sort of a richer set of terms on which we can offer liquidity. But so one direction that this literature and the market can go is more elaborate AMM protocols, and that's kind of a sensible direction. But there's another aspect to all of this that is not quite as we can't be quite as sanguine about, which is that these trades against the AMM, they're not final until they're added to the blockchain. And in that addition process, as the blocks are built and prices change and there is delay as they are added to the blockchain, these AMM trades, they can be broken, they can be repriced, and the entities that do this are builders or proposers. And if you think about a competitive exchange market that manages to equilibrate by, say, a double-priced auction, and then say, okay, suppose we take the role of social planner. Well, most of the time when we do this in economics, we are rearranging transactions and rearranging counterparties in such a way that maximizes the total value, but the total value then accrues to society as a whole. In this case, the builders are also rearranging, possibly transactions, possibly repricing them, but that value, at least at the first round, gets extracted by them. Right? So will it be redistributed to the market as a whole? Some people believe that it can be and that it will be in a competitive equilibrium, but it's an open question. So going forward, and where this literature might go, we think it can go into the analysis of more refined AMMs, but also a very important practical issue is going to be the IO and regulation of these other entities. And this is a big difference from centralized markets. After a trade is done on the New York Stock Exchange, it is immediately passed through to the DTCC, at which point it becomes a locked-in trade. Now, today is the 27th. So tomorrow we go to T+1 settlement. And I know you're all really excited about this and you're going to have parties and break out the champagne and stuff. But really, it's not so much of a big deal compared to settlement in the AMM space, because with DTCC, the prices and quantities and the identities are locked in within microseconds after the trade occurs. Here, there is a 12-second delay. And it's not that we can't say, well, 12 seconds is obviously faster than 1 or 2 days. That's not good enough. The fact is, the 1 or 2 day settlement, that's the eventual settlement, but the terms of trade are locked in. So I expect that this area is going to be an important ongoing avenue of research. And I think this is it. And I'm certainly willing to thank you for your attention. I hope it's been useful, and I'm happy to stick around and entertain other questions.
Well, thank you so much for the presentation, Joel. Let me first ask if there are any, because I don't want to hog the conversation as I always do. Are there any questions that anybody wants to ask directly?
Hey, Joel, quick question. There's in the chat the coexistence and price discovery, which seems like a big first order question. You know, what is their role when there are other exchanges? But do you see a role for this in markets where we haven't seen markets created yet? In other words, when there's very little volume, a lot of no interest, less research, some of these more
Sure.
esoteric markets where we could just program this, let it run, and it becomes the only market.
That's an excellent question. And for that, I think our chair has probably thought more about this than anyone else. And Andreas, if I can quickly paraphrase a large body of your work, if there is a gain, it will probably come from medium, possibly low activity securities. And they don't have to be esoteric things. Andreas has made the case that it could be done for it could be done for medium and low activity stocks, for example.
Yeah, thanks for the plug. I think the idea is so one of the problems with low activity stocks, for instance, is that they have no liquidity, and for that reason, institutional investors often can't put them in their portfolio, because if they have to, they can't trade out of them, and so it kind of creates a chicken and egg problem. And an AMM allows an existing owner of a stock to also be a liquidity provider, so as to earn both fees, trading fees, and have an income also in terms of the investment income. And so with that together, that you can put those together and actually sort of prime the pump of liquidity without having the need for a market maker. And it's a big topic in Canada, where most stocks are actually not traded.
So then all the passive funds basically tag on a little automatic market maker to their holdings and make a little money on the side.
Yeah, that's right. Exactly. So, and you need, I mean, so we have actually, Katja and I have written a paper on this, where you need probably about 5% of the float to be put into this. 2 to 5% of the float needs to be put into these to make it work. I mean, that's obviously it's an ideal scenario, so I don't want to overstate it, but yeah, so there is actually that. Joe, can I ask you a question, since nobody has their hand risen? So you also talked about modeling liquidity provision and thinking about how a liquidity provider wants to choose these options. Do you have a sense, a few things that you want to say about that, maybe?
Yes. For example, it's true. Classic market makers do provide two-sided liquidity although not always on equivalent terms, depending on their positions. But remember, there are many traders out there who use one-sided limit orders as alternative to market makers. And there are a number of order strategies, Funari orders, discretionary orders, and so forth, that rely on the ability to very quickly switch from passive to active at no cost. All right. This is not feasible with these AMMs. To add liquidity to an AMM pool, it has to be two-sided. And to add or withdraw, you need to pay you need to pay gas fees, and it is not instantaneous. My contribution to the pool, that is for me to switch from passive, say, to active, would require, at a minimum, 2 cycles of the clearing and settlement, which on Ethereum occurs about once every 12 seconds. So think about a discretionary order on, say, BATS. I have a bid, but if the opposite quote, the ask, gets within range, the exchange, not me, but the exchange, it's a discretionary order, will cancel my bid and hit that ask within microseconds at no cost. With an AMM, making that same switch takes 12 seconds. It may not work, and it's costly.
Okay. I see Peter has his hand raised. So Peter, why don't you mute yourself and ask your question?
You mentioned that large capital requirement in original Uniswap as a shortcoming. Can minimizing capital requirement be the opposite optimality criterion to unlimited trading range in Uniswap?
In V2, well, really, in all of these AMMs, there is a trade-off between liquidity in the pool and between the pool inventory, the size of the pool, and the amount of the liquidity provided. So yes, you can minimize the liquidity in the pool, but if you do that, you penalize the terms of the trade, and fewer people are likely to send orders to the pool. Now, question, and Andreas, I know you've thought along these lines. Well, maybe you really don't need that inventory in the pool. Maybe you can borrow it, for example. Maybe you can only use it when maybe you only need to be able to access it when you need it. And within our present framework, I'm not quite clear how that would happen, because if capital is in the pool, it's available for making markets. But if it's outside the pool, it might as well be on Mars. It's not available for making the market.
Jackie, you have raised your hand. Go ahead.
Sure. Hi, sorry. This might be straying a bit further from the topics of your talk today. But like, I mean, in your opinion, what do you think there's some kind of like definite Pareto ranking between the V2 and V3 versions? Because like V3, I mean, like obviously, like just as you pointed out, there is this very it solved one of the most significant shortcomings in that it definitely drastically, in some sense of the word, lowered the capital requirements but it also kind of like may on the other hand, it kind of things out the individual AMMs, right? Because like in some sense, the like you can kind of like view the different price ranges separately, and then and that's gonna like that made the phenomenon of just-in-time liquidity to be much more rampant, which I mean, as far as I can recall, it's not something that's very frequent when before V3 goes online.
All right, thank you. There are, I think, two ideas in that question. The first one was something called just-in-time liquidity, and just-in-time liquidity is it's a kind of front running, and we're used to thinking of front running in traditional markets as trading ahead of market orders. But just-in-time liquidity, in a sense, front runs the AMM. And it is something that also occurs really in this process by which things are added to the blockchain. So so how do we deal with just-in-time liquidity? Is it front running? Is it something that should be encouraged or not? Well, this is something that is going to get to the very last point that I made, which is the industrial organization and regulation of the builder proposers, which is something sort of after the AMMs. But your first question about the other idea that you mentioned was, well, when you separate, when you take V2 liquidity and you allow it to be concentrated, that sounds good, but it also fragments the liquidity. And if you want to supply liquidity over a wide range, you may have to invest in multiple V3 pools, and those transactions costs are more expensive than they would be if you were just contributing the liquidity to a single V2 pool. So yeah, that is definitely a design consideration. Also, I should have mentioned that V3 is not backward compatible with V2. That is, the ingredients, the building blocks that go, I probably shouldn't say that one, but the ingredients of a V3 pool cannot be combined in such a way that it replicates any particular V2 pool. They have a lot of flexibility, but they do not have that level of flexibility. Interestingly, we still have both in operation. V3 pools at this point dominate, but V2 pools have also continued to operate as well. So they're not. It's not a V2 is not a completely dominated strategy.
Yeah, and on that end, actually, I mean, for those of you who really are into this and want to learn more, there are interesting side aspects of how actually the trading is even run. Because if you are somebody who is a user, wants to trade against a pool, you usually use a website or an app on a website. And that app basically calls upon a router, which then routes your trade to the pool, which gives you the best price, which could be actually a V2 pool, or could be a V3 pool, or it could be an OTC trade, something that Joel referred to earlier as a just-in-time liquidity trade. So there's a lot going on there. For those of us in microstructure interested, there is a lot of fascinating details in there, which is essentially exactly what we do as microstructure researchers. It's kind of the new frontier.
Yes, however it ends up, this is definitely the space where the most interesting experimentation in microstructure is occurring.
Yeah, absolutely. All right, I don't see any more hands raised. If there's anybody who wants to say anything, this is the time to do it. Otherwise, I want to thank you, Joel, for closing our season this year with an absolutely fascinating talk. I'm really happy that you gave it to us, and for those of your PhD students in particular, at the very least, have a look into it, because this is the frontier. This is where really interesting work happens.
All right.
So
Well,
thank you
thank you
again,
very
Joel.
much, everyone. It's been for your questions and your attention. It's been my pleasure.
Thank you, Joel. Great paper. All right. So just a quick reminder, the call for submissions for the fall season is now open. You can find it on our website and in our emails. And with that, I wish everybody a happy summer. Probably see each other at some conferences at some point, and all the best to everybody.